Central Bank Gold Reserve Strategies, the Great East-West Divergence Executive Summary. The global monetary landscape is experiencing a fundamental shift in central bank reserve management strategies, with emerging market economies systematically increasing gold allocations while developed nations maintain traditional dollar-centric approaches. This divergence reflects deeper structural changes in global finance, geopolitical risk assessment, and monetary policy frameworks that could reshape gold market dynamics for decades. The structural transformation in central bank gold purchases reached extraordinary levels over the past 3 years, with official sector demand averaging 800 to 900 tons annually, the highest sustained buying since the 1960s. However, the distribution of this demand reveals a striking geographical pattern that mirrors broader shifts in global economic power. Eastern central banks, particularly those in Asia and emerging market economies, have driven this surge. The People, as Bank of China reported adding approximately 225 tons to its reserves in the past 18 months, though market analysts suggest actual accumulation may exceed official figures significantly. The Reserve Bank of India has similarly expanded its gold holdings, while central banks across Southeast Asia, Latin America, and parts of Africa have followed suit. This contrasts sharply with developed market central banks, which have remained largely static in their gold allocation strategies. The Federal Reserve, European Central Bank, Bank of Japan, and Bank of England have made minimal changes to their gold holdings, maintaining the status quo established in the post-Bretton Woods era. Economic drivers behind the divergence: currency, diversification. Imperatives: the primary driver appears to be currency diversification concerns. Emerging market central banks hold approximately 60-70% of their reserves in US dollar-denominated assets, creating significant concentration risk. As global trade patterns evolve and bilateral trade agreements bypass dollar settlement systems, these central banks are reassessing optimal reserve compositions. Gold offers several advantages in this context. Unlike other reserve assets, gold carries no counterparty risk, a critical consideration as geopolitical tensions rise. It provides portfolio diversification benefits that become more valuable during periods of currency volatility. Historical analysis suggests gold holdings can reduce overall reserve portfolio volatility by 5 to 8%, while maintaining liquidity characteristics superior to many alternative assets. Inflation hedge mechanisms. Real interest rate environments have created compelling conditions for gold accumulation. With many emerging market economies experiencing elevated inflation pressures while maintaining accommodative monetary policies to support growth, real rates have turned negative in numerous jurisdictions. Under these conditions, gold's zero-yield characteristic becomes less of a disadvantage relative to short-term government securities. Central banks in countries experiencing persistent inflation above 4 to 5% annually have shown the strongest propensity for gold accumulation. This reflects gold's historical performance as an inflation hedge, particularly during periods when conventional monetary policy tools prove insufficient to anchor price expectations. Geopolitical risk. Premium, the weaponization of financial systems, has introduced new considerations into reserve management decisions. Economic sanctions targeting central bank assets, restrictions on swift access, and asset freezes have highlighted vulnerabilities in traditional reserve holdings. Gold, stored domestically or in neutral jurisdictions, offers protection against these risks. This consideration has proven particularly influential for central banks in countries with complex geopolitical relationships or those seeking to maintain strategic autonomy. The ability to hold reserves beyond the reach of foreign jurisdictions has become a significant factor in portfolio allocation decisions. Regional analysis. The new gold buyers: China. Strategic accumulation. The People, as Bank of China's approach represents the most significant development in official sector gold demand. While official reports indicate modest, steady accumulation, several factors suggest actual holdings may be substantially higher. China's domestic gold production, approximately 330 tons annually, rarely appears in export statistics, implying domestic absorption. Import data from Hong Kong and other channels suggests physical gold flows into China far exceed official reserve additions. Market analysts estimate China's actual gold reserves could be 3,000 to 4,000 tons, nearly double the officially reported 2,235 tons. This accumulation strategy aligns with broader Chinese financial policy objectives, including reducing dollar dependency, supporting the internationalization of the yuan, and building strategic reserves ahead of potential economic or geopolitical disruptions. The scale and persistence of buying suggests a long-term strategic commitment rather than tactical portfolio adjustments. India's growing confidence. The Reserve Bank of India has emerged as another significant accumulator, adding over 200 tons since 2021. This represents a departure from historical patterns, when India's central bank maintained relatively stable gold holdings while focusing on building foreign currency reserves. The shift reflects several considerations unique to India's economic position. As the world's largest gold-consuming nation, domestic gold holdings provide natural hedging against import costs. The country's substantial current account deficits make currency stability a priority, and gold holdings can help smooth balance of payments pressures during periods of capital outflows. India's approach has been notably transparent, with regular announcements of gold purchases and clear communication about strategic rationale. This transparency may reflect confidence in the policy direction and desire to signal long-term commitment to gold as a reserve asset. Emerging market. Momentum, smaller emerging market, central banks have collectively contributed significantly to global demand growth. Countries including Kazakhstan, Uzbekistan, Turkey, and several Latin American economies have increased gold allocations, often dramatically. These purchases frequently coincide with domestic gold production, suggesting integration of monetary policy with natural resource development strategies. For commodity-producing economies, holding reserves in gold can provide natural hedging against terms of trade shocks and currency volatility. Developed market perspective, status quo. Maintenance traditional reserve management. Western central banks have maintained largely static approaches to gold holdings, viewing them primarily as legacy assets rather than active portfolio components. This reflects different risk perceptions, institutional frameworks, and policy objectives compared to emerging market counterparts. The Federal Reserve's gold holdings, approximately 834 tons, represent roughly 70% of total reserves by value, but this high percentage reflects gold's price appreciation rather than active accumulation. The European Central Bank maintains similar passive management, viewing gold as portfolio ballast rather than strategic asset. Institutional and political constraints. Developed market central banks face different institutional constraints that may limit gold accumulation flexibility. Parliamentary oversight, transparency requirements, and established policy frameworks create inertia around major portfolio allocation changes. Have you ever wondered why gold, a metal we've cherished for thousands of years, is suddenly making headlines again? It's not just about jewelry or investment portfolios. Something much bigger is happening behind the scenes in the vaults of the world's most powerful central banks. And what's fascinating is the stark difference in strategy between East and West. This isn't just about shiny bars. It's a story about power, trust, and the future of the global financial system. Let's start with the West. For decades, Western central banks, like the US Federal Reserve and the European Central Bank, have been relatively quiet on the gold front. After the gold standard ended in 1971, currencies like the US dollar became the backbone of international finance. These banks hold massive amounts of gold, sure, but their reserves have been mostly static, and in some cases, they've even sold off portions. Think of it this way. Their financial power has been based on the strength and stability of their currencies and economies, not just their gold holdings. The dollar is the world's primary reserve currency, used for everything from oil trading to international loans. For them, the system works. But now, let's turn our gaze to the East. A completely different picture emerges. Countries like China, Russia, India, and Turkey are on a gold buying spree. They're adding tons of it to their reserves, month after month. Why? Well, it's a multi-layered strategy. First, it's about diversification. Relying too heavily on a single foreign currency, like the US dollar, carries risks. What if that currency's value fluctuates? Or what if political tensions rise? Gold is a neutral asset. It's not controlled by any single government's policies. By holding more gold, these countries are building a more resilient financial foundation, insulating themselves from potential shocks in the dollar-centric system. Think of it like your own investment portfolio. You wouldn't put all your money into one stock, right? You'd spread it out. Eastern nations are doing the same on a massive scale. They're diversifying away from the dollar and into an asset that has held its value for millennia. This is often called de-dollarization. It's not about crashing the dollar tomorrow, but it's a gradual, strategic shift to reduce dependency and increase their own financial sovereignty. Let's look at some numbers to see how real this is. The People's Bank of China has been a consistent buyer, reporting increases in its gold reserves for over a year straight. Russia has also been aggressively accumulating gold, partly as a way to shield its economy from Western sanctions. India, a country with a deep cultural affinity for gold, has also been steadily increasing its official holdings. The trend is undeniable. The center of gravity for new gold demand is shifting eastward. So what does all this mean for the rest of us and for the future of global finance? This east-west divergence in gold strategy is more than just a footnote in economic reports. It's a powerful signal of a changing world order. The unipolar moment, where the US financial system was the undisputed center of the universe, is evolving. We are moving towards a more multipolar world with multiple centers of economic power. Gold is playing a key role in this transition. It's a silent but powerful statement of economic independence and a hedge against an uncertain future. This isn't about predicting a financial doomsday. The US dollar isn't going to disappear overnight. It's still the most dominant currency by a long shot. However, the ground beneath our feet is shifting. The accumulation of gold by Eastern central banks is a vote of no confidence in the long-term stability of the current system. It suggests they are preparing for a future where the US dollar might not be as dominant, and where tangible assets like gold regain prominence as pillars of monetary trust. For you, the viewer, this is a fascinating trend to watch. It affects everything from currency exchange rates to the prices of goods we import and export. It's a reminder that the global financial landscape is constantly in motion. The quiet, steady accumulation of gold in Eastern vaults could be one of the most significant, yet underreported stories of our time. It's a chess game being played on a global scale, with bars of gold as the pieces. And the outcome will shape the economic world for generations to come. So, next time you hear about the price of gold, remember it's not just a number. It's a reflection of a deep strategic realignment happening between the East and the West. A story of power, trust, and the quest for financial security in an ever-changing world. What do you think is the ultimate goal of this gold-buying spree? Let me know your thoughts in the comments below. Thanks for watching. If you found this breakdown interesting, make sure to hit the like button and subscribe for more deep dives into the forces shaping our world. See you in the next video.